John Lipsky is the chair of the NBER, the National Bureau of Economic Research, the body that officially declares a recession in the US. John's with me now. John, look, I know that your recession committee, it's always an ex post facto. It's many months after the event. But are they even looking at recessions?
Well, they're always looking. But of course, the definition of recession, as you can find on the NBER website, is a generalized decline in activity that is sustained. So you can look for yourself at the various points of information that are of importance to the Business Cycle Dating Committee, but and you can draw your own conclusion. But obviously 2.4% real growth is not a recession.
What's going on, John? I mean, in all your years of looking at economies, to have had such monetary tightening after a pandemic, even allowing for pent-up demand, and we're still seeing this level of economic growth with low unemployment. Is the Phillips curve broken?
Well, the Phillips curve has been broken for some time. In fact, you have to ask we don't want to get into jargon here. Phillips curves, the notion that the inflation rate will be inversely related to the unemployment rate, lower unemployment, higher inflation. That idea is that wages are necessarily reflect, or growth in wages reflect changes in the unemployment rate. But those earlier calculations were for a much less competitive market than we have today. And for some time, the linkage between unemployment, wages, and inflation hasn't been anywhere near what it has been in the past, much looser reaction. But I think you put your finger on what's new this time, and that's the pandemic that initially created a shutdown that restricted supply on the service sector and focused demand in the goods sector, produced bottlenecks that shot up inflation in the goods sector that is now going away. The reopening of the economy produced strong demand in the service sector that is producing an increase in prices, but all that seems to be fading and fading rapidly.
I know you subscribe probably to the 2% inflation target, but does the Fed need to push inflation down to 2%? This idea of higher for longer, well, whether or not we've had the last rate rise is academic. We know those rates are going to remain up there. Do they need to remain until you see that magic number of 2%?
Not necessarily. After all, the Fed says that they're data dependent, but they can't define exactly which data they're dependent on and exactly what that dependence means. They're data influenced and judgment dependent. But they want to say higher for longer to make sure that folks understand that they're serious about hitting their inflation target. But do they need to continue raising rates to accomplish that? Already, the demand for year-on-year inflation for goods prices in general has come way down and is below 2%. Housing on the margin, housing prices seem to have come off very sharply. And we know that the measurements that go into the price index are quite lagged. So right now the focus is on the labor market. But even today, wage gains have only replaced or have restored real wages from what they were before the pandemic. There isn't any clear evidence that wage growth has been fueling inflation. And if that's the case, certainly current real interest rates are quite high.
If in all of this, the market seems to want to rise. I mean, it doesn't, the market always tends to be marginally optimistic at the best of times, but it's taking every scintilla of encouraging news as an excuse to put on weight. Should we be guarded against that?
Well, of course, you always need to be to look closely. However, the most salient point here is that since the turn of the century, profit margins and profit share of GDP has been much higher than it was previously, and that has been sustained. And what the latest data seem to say is that effect, that high profit, high margin economy has survived the pandemic, hence adding to optimism. Now, when we can, yeah, go ahead.
Well, one final thought. You know, I remember in the 90s during the internet, Alan Greenspan was always talking about whether we had a new paradigm. Could we now have higher productivity and low inflation at the same time? Do you see the post-pandemic world as an economic world as an adaptation of the old, or as a new paradigm?
Let's call it an adaptation of the old. What is promising, like in the mid-90s, when Chairman Greenspan was paying attention to trends in productivity, he was early in recognizing the digital revolution was going to impact the economy. It looks like we could be on the edge of a new phase of progress in the so-called digital revolution that could have a real impact on productivity. In any case, the economy is performing better than most people expected. And I think increasingly investors are optimistic that growth will be sustained and inflation will come down relatively rapidly, obviating the need for future Fed tightening.
John, it is always good to speak to you, sir. I'm grateful for your time always. Thank you, sir.
Happy to. Richard, always a pleasure.
John Lipsky.